Hello, 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 everybody. Today we're going to learn about understanding price reversals, the laws of trading reversals. And once again, my name is the Beast Trader, and I live a freedom lifestyle. That's our slogan. That's what we go by: financial freedom, time freedom, and spiritual freedom. So let's go over just the basics of price action reversals. Reversal is when the direction of a price trend has changed from going up to going down or vice versa. Traders try to get out of positions that are aligned with the trend prior to reversal, or they will get out once they see the reversal underway. Reversals typically refer to large price changes where the trend changes direction. Small counter moves against the trend are called pullbacks, or we call it breathing, or it's when the trade enters consolidation. When it starts to occur, a reversal isn't distinguishable from a pullback. A reversal keeps going and forms a new trend, while a pullback ends and then the price starts moving back in the trending direction. So this is what we're talking today, and these are the keys to what we're going to be going over. All right, trends and reversals can be identified based on price action alone, or other traders prefer the use of indicators. Moving averages may aid in spotting both the trend and reversals. If the price is above a rising moving average, then the trend is up. But when the price drops below the moving average, that could signal potential price reversal. And so let's look right here what we're talking about. This was taken from basically the Beast Trader Bot 1.0. And what we see right here is the simple moving average, the SMA. Okay, and the SMA is going to tell us if something's in an uptrend or a downtrend. Okay, and now next we have the exponential moving average. The exponential moving average is called the EMA. So you'll hear me say SMA for simple moving average and EMA for exponential moving average. And these are the lines on top right here. The blue one is the regular EMA, and the orange and the green are different EMAs that are calculated by the Beast Trader bot. Now, when is a reversal happening? Okay, we see it's in an uptrend, the simple moving average, the candles are above. Right here is where it kind of consolidates, and then the candles go underneath the simple moving average. That's when a reversal happens right here. You know, it consolidates and then it goes in the other direction. Now, this is a true reversal because now we see it starting to go down, 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 and it's staying underneath the simple moving average. Okay, that's a simple definition for the price reversal. So trend lines and reversals. Trend lines are also used to spot reversals. Since an uptrend makes higher lows, a trend line could be drawn along those higher lows. When the price drops below the trend line, that could indicate a trend reversal. If reversals were easy to spot and to differentiate from noise or brief pullbacks, trading would be super simple and easy, everybody, but it's not like that. This just isn't the case. Whether using price action or indicators, many false signals occur, and sometimes reversals happen so quickly that traders aren't able to act quickly enough to avoid a large loss. And this is what I'm finding out with most people: when you're losing because you don't know when it's actually just going into consolidation, or if it's staying in the same trend, or if it's doing the reversal. And what's making you guys lose is when it goes into reversal and it's going to hit your stop loss. And sometimes you guys aren't putting your stop loss good, so you guys lose a lot. So the difference from, remember, fake signals, the noise, pullback, breathing, that's what we're talking about, are the real reversal that happens. All right. You guys have to know this. So let's just look right here. There's higher highs, higher lows. And basically you could put this line right here on the bottom. This is a support. This will be the resistance. And you notice that it's in a diagonal order and it keeps on going up. But right here, what happens is it goes underneath this support. The support is right here, and right here, it broke support. And usually it breaks support on a big candle like this one. And this is where the reversal actually occurred right here, when it starts consolidating underneath the support line. And then you have just a big fallout, and the reversal has happened, and it's too late for you to move your stop loss back up here. So you should have had your stop loss a little bit under this support line right here, just like probably right here. Once this started happening right here, you should be out. But people say, oh no, it's going to go back up. No, but what happens is it falls back, and you might have your thing way down here somewhere, and you're going to lose big because it does a big drop right here and it's way down. So you guys be careful of that. So consolidation can turn into what? Price reversal. Remember, in consolidation, only two things could really happen. Consolidation is never going to end up being forever. So a trade is either in an uptrend, consolidation, or in a downtrend. It has to be in those three different things, right? So when you're in consolidation, you could trade in consolidation, but you know that, it's going to change eventually. And then if you're trading in, consolidation, you want to lose a little trade because you're only making a little bit of profit each time it goes up or goes down because it's in consolidation. It's not going up super high and not going down super low. So you want to have your stop loss. So then when it does pivot, what we call it, or reverse, then you're not going to lose that much. Let's look at what we're talking about here. Let's take this as the graph. It's going up and down, as you guys can see. So step one is in an uptrend. So what we're talking about is it's going up right here, right? It gets up to this spot, and then this is the higher high, right? Now it does what? It goes back down. Step three, this is called a pullback or breathing, or we call it noise. The different traders call it different things. I call it breathing because I look at this as a sprinter running up a hill, getting tired and having to rest a little bit and taking their breath, and it goes back down. And then they start sprinting again and it goes back up. So what happens? This is called the second higher high. It didn't go higher than the first high. It just went to the same level. This is a sign of reversal, where this is consolidation. It's going up, down to the same level, up to the same level. The second time it does that, we got to be careful and we got to stop trading like this is in an uptrend, right? The next thing that happens is a sign of reversal. This right here is your sign of reversal. After it hit the second high and it starts just coming down a little bit, some traders would take this going down, thinking that this is a sign of reversal. So what can happen here is that, yeah, you can make money. If you get in at the top again and you see that it leveled off at the same spot and it starts going down a little bit, you get in maybe right here and you can take it down, and you want to get out before it gets to the lower the last time. You want to get out probably right here, take your profit, right? So what is that called? That's called the second pullback or breathing. So when it does this 2 times, now you have a rhythm. Sometimes we call this a cat on a string. It does the same thing over and over and over again. You can really trade this going up, trade it going down, trade it going back up because it's in consolidation, right? Now, what happens on this determines on what's going to really happen in the trade. Now, if it goes back up and goes up higher than the before higher highs, then it's staying in an uptrend. If this line pulls down right here, that means it's in a reversal. So in this case, it goes back up. We got a rocket ship. Now we got a new high for the original trend that we already had before going up. And so it just keeps on going up, and then it does the consolidation again. So this is what, a price reversal, either going up like this, or if it's going down in consolidation, we don't know what it's going to do. Sometimes I say it's in the middle. We don't know what it's going to do. So the difference between a reversal and a pullback or breathing, right? A reversal is a trend change in the price of an asset. A pullback, breathing, is a counter move within a trend that doesn't reverse the trend. An uptrend is created by higher swing highs and higher swing lows. Pullbacks create the higher lows. Therefore, a reversal of the uptrend doesn't occur until the price makes a lower low on the time frame the trader is watching. Reversals always start as potential pullbacks, which one it will ultimately turn out to be is unknown when it starts. Because if we knew, we'd just trade it going down. But sometimes you start trading it going down and it's not good because it's going up still. I'm only going to trade when it's going up. I'm only going to take up trades. I'm only going to take buys. Even when it consolidates, I'm still only going to take buys until it breaks, because most of the time, maybe 60 or 70% of the time when it consolidates, it usually goes in the same direction more often than it goes in a reverse. So that's why I always am a trend trader in the same trend. I don't go both ways. All right, limitations in using reversals. Reversals are a fact of life in the financial markets. Prices always reverse at some point and will have multiple upside and downside reversals over time. Ignoring reversals may result in taking more risk than anticipated. For example, a trader believes that a stock which has moved from $4 to $5 is well positioned to become much more valuable. They rode the trend higher, but now the stock is dropping to 4, 3, then to 2. Reversal signs were likely evident well before the stock reached $2. Likely they were visible at before the price reached $4. Therefore, by watching for reversals, the trader could have what? Locked in profit, or kept themselves out of, now a losing position that keeps on going down. And this is what we care about. We care about, lowering the losses and maximizing the profits. When a reversal starts, it isn't clear whether it is a reversal or a pullback. Once it is evident it is a reversal, the price may have already moved a significant distance, resulting in a sizable loss or profit erosion for the trader. For this reason, trend traders often exit while the price is still moving in their direction. That way, they don't need to worry about whether the counter trend move is a pullback or reversal. So this is probably the number one problem of everybody, is discipline. Number one, really. Number two is not knowing where to set their stop loss and taking a little loss instead of a big one. And then number three is this right here. Once it is evident it is a reversal, the price may have already moved a significant distance, resulting in a sizable loss or profit erosion for the trader. For this reason, trend traders often exit while the price is still moving in their direction. So when it's still moving in our direction, we already got out of the trade. So when it starts going back down, guess what? We're not taking the loss going back down. And when it goes back down, if we get it at a lower price, let's say we take it at $3 and it goes up to $4 or $5. Let's say we get out at $5, right? It goes back down to $3 and then we take it again going up, right? Because we already took our profit at $5. It goes back down to $3. We take it going up and then it goes down to $2. Guess what? You won $2 and you only lost $1. So you're up. Now, if you're at $2 or $3 and you take it up to $5 and you say, well, I'm going to wait and get greedy and take it to $7, and it goes from $5 down to $2, guess what? Guess what just happened? You didn't win anything. All you did was lose. You lost $1 instead of winning 2, losing 1, and now you're up 1. Now, if you just stayed in there, you lose the whole thing. You don't win anything. So that's the difference. False signals are also a reality. A reversal may occur using the indicator of our price action, but then the price immediately resumes to move in the prior trending direction again. What is price action? Price action is, looking without really indicators. All you're looking at is the candles, and you might be looking at a Bollinger Band and moving averages. You're not looking at everything else. You're just looking to see, where the support, where the resistance is, and you're going from there. It's some people call it naked trading because you're not using that many indicators. So let's look. Accumulation. Accumulation means what? It's going up. So it consolidates, it keeps on going up, going back down, and then it breaks through that, right? Goes up. Now you're marking up, you're making all this money going up. Now it comes to distribution. Is going lower. The higher part isn't going higher. You're noticing right here, it started up higher. It went lower the second time on the top. And then you got this right here. Then it goes up one more time. This is a good time to be in a reality with yourself that is probably going to go back down. And then you got this going. And once it breaks through right here, it breaks the lower lows. Then you possibly have a reversal. Now, the only time you know if it's a real reversal is when it pops back up and it uses most of the time the support, it turns into a resistance and it hits that line that used to be the low, and now that turns up into the high, and then it starts going down. All right, let's look at a few different examples, okay? A trending move is the stronger leg of a trend, and it trades in the same direction of it. That's why we call it that. The trending move is a healthy uptrend, usually has more bullish than bearish candles. The bullish candles are relatively larger than the bearish ones, and the bullish candles closing near the high. So if we look, we're noticing that we get more candles that are green, and they're usually a little bit bigger. This is an actual real market. We notice right here, it went high, it went back down and breathes. It went back, what, higher, right? It breathes again. Now the low is a little higher than it was right here. It was right there. Now it's right here. Now you get these big candles, boom, 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 a couple of breathing candles, right? Boom. And then it consolidates right here, and then it starts breathing, and then it takes off again. Boom, goes way up, consolidates, breathes, goes up again. Boom, right? And then right here, you get these two big red candles. These two big red candles are something that you're like, oh man, this is probably going to pivot right here. So you might have got in one more time for it to get up when it shot back right here, probably at this low. And when you seen the next candle opens up and starts going low, you probably got out around here, because it doesn't look like it's going back up too good on this one. All right. When the bullish candles are getting smaller, it's telling you the buying pressure is getting weak, or there is equal selling pressure coming in. Now, this doesn't guarantee the market will collapse lower, but it is a tall tale sign that the buyers are getting weak and may need a pause before staging another move higher. So this is an uptrend, a lot of consolidation, uptrend, big time breathing, going back down even lower than the other one, another consolidation, and then back into a little bit of an uptrend, and then consolidation right here. But you started noticing the green candles are getting littler. You see how they keep on wicking, and it's only a little bit of green, and you notice that the red candles are getting bigger. Green candles are getting littler, red are getting bigger. You know, this means that a trend is usually reversing when, you know, the direction that it's supposed to be going in, the candles get littler, even though it still looks like it's kind of moving up, or it looks like it's consolidating. There's a lot of more wicks that are going to be on the trend, you know, color. So this is an uptrend, and you see every green almost has a wick, and these red ones are getting strong, the whole candle. That's a sign, like right here, it wicked up, and then it came right back down. That's a sign that there's going to be a reversal in store for you. A retracement. A lot of people don't know what retracement means. Retracement move is the opposite of the trending move. It's the weaker leg of a trend, and it trades against the direction of it. That's why I call it a retracement move. The retracement move in a healthy uptrend usually has more bearish than bullish candles. The bearish candles are relatively small, and it is usually closes near the middle or high of the range. So what does that mean? We got these little red candles that are bringing it down over and over and over again, right? But we got these big green candles that are moving the trade up higher and higher each time. So if you look, it's going up, it's in an uptrend, right? But this part right here, there's way more red candles. And then the next part, when it started breathing, there's way more red candles. And then it shoots back up on a big green, and then it starts consolidating, and you got, again, more little red candles, and it shoots up, and then you got more little red candles, and it shoots up again. So these retracements, you want to make sure that, you know, you try to get in at a good spot. You don't want to get in, they call it the top of the rocket. Let's look at this as like a rocket ship. The top of the rocket is when it's still going green. You don't get into the trade when it's still moving upward. You get into the trade when it goes back down, like right here. It went up, it went back down to this point. This might be a good time to get back in. But you don't want to take the trade right here at the top of this candle and get in, because what happened? It went back down, but yeah, it did go back up. How about if you got in right here at the top of this and it fell back down right here? It would have took you, 2 candles to get back to where you really were. And if this happened before, like let's say you got in right here at the top of this green candle, and yeah, and you're happy it went up a little bit, but then it just starts collapsing. You could lose a lot of money that way. So never get in at the top of the candles when it's in an uptrend. You always want to wait for it to bounce. That's why I invented the bounce strategy. As a trend matures, it will move into a distribution stage where both buyers and sellers are in equilibrium. This looking like a range market. Range also means consolidation. Consolidation. At this point, it's clear the area of support is an important level as it's the last line of defense for the buyers. If it breaks, it pretty much game over for the bulls. The bulls mean the people that are buying. Bears are people that are selling. Based on my experience, the more time support is tested within a short period of time, the greater likelihood it's going to break. If you want to learn more about trading the break and support, then go watch that video that I made about support and resistance. Okay, but look at this right here. Check this out. It's hitting this support over and over and over again, right? That's what we're talking about. So the more time it keeps on testing the same support, is usually going to reverse and go below that. It's usually not going to just hit this support over and over and over again for too long and keep on going up. And that's your last line of defense. This is like, the military down here protecting our wall. This is the wall to our city. They do not want them to breach our wall. Once they come in here, it's like they can overtake our city. And that's how I look at trading like that. Like they break this wall right here, they can overtake us and switch this whole trade around and we start losing money. That's why I want to get out of the trade a little bit underneath, the support. Probably right here, you might have want to get out right here. You probably got tapped out, It might be a little lower for that. Depends. All right. There are times when the market respects an important trend line and it breaks. It's a sign that the buyers are getting weak. So what you've learned earlier are analysis techniques to help you analyze when a trend will reverse, but that's not enough because the structure of the markets is always changing. Sometimes it respects a support or resistance. The next time it could be a trend line, et cetera, et cetera. It could be breaking through. It could be reversing, right? Right here, we got a good trend line going up. Every time it hits it, it goes a little under and goes back up. Beautiful. And we win. Every time we take this trade to buy, we win every time. Doesn't this look like our super trend way of trading? Hitting the EMA and going right back up. Yes, it does. But right here, what happens? Look at here. It breaks through the trend. That's why when I'm trading with you guys, say, hey, if it goes lower than this, then we want to stop trading. Because I don't want you guys to think that it went lower and that's even a better price. That's not a better price. That's usually a sign that it's going to go back down. And sometimes when I tell you when it barely breaks through, I say you might be able to take it one more time up. Like this right here, broke through a stop. You could take it up one more time sometimes. Sometimes you can even take it 2 more times up. And that's it. And then it just does a big drop usually. It's no surprise a higher time frame carries more weight than the lower time frames. All right. This means the support on the weekly time frame is more significant than support on the 1 hour time frame. So if you see the market suddenly reverse, chances are it came into a higher time frame structure like support or resistance and reverse from it. So what am I saying here? I'm saying when we trade on the 1 minute time frame, right? And I tell you when the bot does it too, when I do it, anything can happen. It's a lower time frame. It could go up and down really differently. When you're doing the 5 minutes, it's a little more structured. It usually stays with it. If you do an hour or half an hour, it usually stays with it even better. That's why I tell you guys, trade the half an hour and 1 hour is way better than trading the 1 minute and 5 minutes. Right? So the higher time frame you're looking at a trade and a trend, the better results you'll usually have if you have the right analysis. Why did the price reverse right here? Well, we see that there was a support here. It hit the support again, hit it again really quick. Then it hit it again right here really quick. Then it hit it again and again. Every time it's hitting, it's saying, whoa, what's going on? And then it just takes off like a rocket ship. When it starts testing that same, support or resistance over and over and over again in a short period of time, is usually a good sign that the trade is going to reverse. Now you can get your money, but you just have to put your stop loss pretty close so then you don't lose too much if it goes the wrong way. A parabolic move usually occurs when it is in a long-term uptrend and the market suddenly goes ballistic and moves vertically higher, like a rocket taking off. This is a rocket part that I always talk about when it just takes off. And some people, I was talking to somebody the other day and he was like, man, where's your stop loss? It was like $5 out on like a gold or something, but he only wanted to make, like $100, but his stop loss was set to lose like 2,000. That's not good, because what happens sometimes is this rocket ship, it take you the wrong way, and you don't want to be on the top of a rocket ship. As little kids, I'm not talking about any rocket ship, I'm talking about like that little rocket ship the little kids play with. They got a little, needle on the top of it, a short point. Just think about a human standing on the top of that and it going up. What's going to happen? You're going to fall off and start going down really quick. You always notice that the range of the candles in the parabolic move is much larger compared to the earlier ones. When this occurs, it's usually a sign the uptrend is coming to an end as the dumb money is rushing to enter the markets. What's dumb money mean? They call dumb money, if you ever hear that term, that's talking about little traders. There's a cumulative body of little traders that are trading, and most of them don't know what they're doing unless they have a coach or a trainer. Most of them are just throwing money at the wind. So they look, at this and that, they just put in money. All right. Just like you could compare this to like Bitcoin. When Bitcoin went up to 20,000 the first time, they were saying taxi drivers, everybody cashed out their money and started buying Bitcoin at $20,000. Well, what happened? The savvy investors knew and they took all their money out. That's called the smart money, the people that do this for a living. Money is rushing to enter the market while the smart money is exiting their trades. So that's how these big people make a lot of money, is the money that goes in is the people that don't know what they're doing, and the money that goes out is the people that know what they're doing. Thus, what you get is a huge spike in volatility. Say if you notice a market that's been trading for a while and it suddenly goes parabolic, is a good sign that the top is near. What does that mean? Parabolic, right here. It starts going crazy. Big candles going up. Everything was these little candles, and then all of a sudden it started going big right here, and then these three big ones. Usually when you see three big ones, what does that mean when we see that in a trade? That usually means it's way outside of what? The Bollinger Band. It went up too fast. The Bollinger Band's probably right here, and it went all the way up here. What do we know is going to happen when it goes outside the Bollinger Band? Well, in reality, the trade only goes outside the Bollinger Band 5% of the time. So that means 95% of the time it's going to be inside the Bollinger Band. So should we believe it's going to keep on going up if the Bollinger Band's way down here? No, that's when we should say, oh, it's about to go down, and get out. Get our money, get our profit, and wait for it to go down, or take it going down if you want to, right? That's a more of an advanced trade for you to take it going down when it's in an uptrend, when it's way outside the Bollinger Band, but it works. I don't trade like that. I'd stick with the trend and you'll be better off. How about if this is way above the Bollinger Band right here? And then you say, oh, I'm taking this going down. Well, guess what? You lost a lot because it kept on going up for a while. So that's why I only trade going one direction for me. And that's what I'm going to stick to. The range of the candles at its largest before the collapse. Same thing. Two big candles moving up, right? And it still goes up a little more, but it's a sign that it's going to reverse right here. Because this is like everybody, like all these wise investors, smart money's coming in and it's driving it up. Hey, it's worth more, it's worth more, it's worth more, it's worth more. Then, they call this the dumb money. The dumb money comes in parabolically, changes the whole trade, pushes it up so fast that the people down here that put their money going up, guess what? When they see this happen, they're like, oh, I got to get out. So then they sell really quick because they already know what's going to happen. Everybody that's wise is going to start selling this because it's way outside of the range that it should be in. And then that's when you get the collapse going back down. So a wise person, this is on the day calendar. No, this is 1 week. So this is corn for 1 week. I found this little thing. So it goes up right here, corn for 1 week, each one of these candles. And these people are trading all the way down here. They get to here and they see this big candle. Man, they're probably out at the first big candle. Somebody that got lucky, they might have forgotten. They got all the way up here, but definitely everybody's getting out right here. They're not even worried about this one right here. They're not going to say, I missed this money right here. No, because they seen this red candle come down really quick off the parabolic up real fast going down, and they know what's coming. They'll probably end up getting in up here. If they made all this money coming up, they'll probably get in up here for it to go down some. And they'll probably get out, you know, probably around this little area right here, right when it gets to this parabolic second candle. They'll probably, because what could happen is that parabolic candle, when it starts going down, it could act as a support and start going back up right here, but not in this case. All right. How do I identify high probability trend reversals? Okay, let's look. This is a trend line, an uptrend line, right? Now, when it starts breaking, it hits right here, good. It hits right here, great. But then it broke through right here. It broke through right here. And that's what you know where you stop trading going up once it breaks this moving average so fast and so hard like that. It went down too fast on this candle. You know, another thing is you get this double push up, and push down. We call that head and shoulder tops. I call it double push up. Head and shoulders. It looks like a human's head with shoulders on each side, almost the same length, and then it goes down, right? You got this head right here, shoulder, and then it goes down. So if you ever hear head and shoulders, that's what we're talking about. Let's look. It retests right here. It hits. Okay, that was the previous highs. It bounced back down and went here and consolidated. Went back up. It did the same thing. Now you see increased selling. These big reds right here. This is a good sign of what's going to happen. Decrease in people buying, and the pressure is going to be to sell right here. This is a reversal. Boom. This was also a reversal, but then it consolidated. All right. When the bearish candles are getting larger, it's telling you to sell. The selling pressure is getting stronger as the buyers are unwilling to buy at higher prices. Again, this doesn't guarantee the market will reverse from here, but it's another sign the buyers are getting weak. So all this green going up, and you guys can see right here, this is a big thing with red going down. So that's the end of it. Right here, it consolidated. It starts going down. You're not trying to get this to keep on going up right here. This is it. You know, you're either selling for this to go down or you're just waiting on another trade. That's why we trade 4 or 5 different things. So we don't have to get trapped in just trading one thing. And when something weird happens, that we're stuck. And weird meaning the price basically does what? Reverses. That's when I call something weird because it's not doing what it was normally doing. So let's go over the beast trader. And the beast trader is a trend trader. I'm talking in third person. So I am a trend trader. And I invented the bounce strategy. And the bounce strategy has different components to it. But today I'm going to talk about the super trend way that I trade. This is vital to what we're talking about on price reversals and knowing if it's going to reverse or knowing if it's going to stay in the same trend. So we're using a rocket ship. This is what I'm telling you, because if you're on the top of that rocket ship, you see how it's pointing and you'll fall off. So don't ever trade at the top. Don't ever trade at the bottom of where the rocket ship is going. Always remember that. You want to trade when it bounces. That's why we invented the bounce strategy. Here we go. Number 1 is trade with the trend. No, that should say wait for pullback, then trend trade. So you want to wait for the pullback, then trend trade. Wait for it to breathe first and then go in and go up or go down after it breathes and goes the wrong direction when it's in the trend. Don't take the trend when it's at the top of the trend and start trying to trade it go up, because what's going to happen is there's going to be a pullback or breathing, and then you're going to be upset. You're going to be losing. Number 2 is super trend trades. What does that mean? Wait for 100% trend. Once it's in 100% uptrend or downtrend in the lower time frame candles, that's in the 1 minute and 5 minutes, right? Then you look at the higher time frames, like the half an hour, 1 hour. Are the candles still in the same trend? Are they going up? Well, if that's the case, if the candles are in an uptrend on the higher and they're in the lower, that means you're in a super trend. That means that everything is in agreement that this is in a trend going up. Now you know you could trade going up, and it's very safe. All right. So where do I know to get in, Beast Trader? Okay, right here. Buy and sell at what? The EMA. Wait for the trade price to hit the EMA and buy or sell with the trend. So wait for it to breathe, hit the EMA, and then you take it going up or down according to what trend it's in. Number 4 is When do I take profits? I don't know when to get out the trade. I stay in too long. Okay, well, take profits before the Bollinger Band. You want to take profit before it hits the Bollinger Band. So if you're going for it to go up, it hits the EMA, you take the trade going up. Before it gets to the Bollinger Band, get out the trade. It could be halfway up to the Bollinger Band, or 75% or 90% all the way to the Bollinger Band. Get out before it touches the Bollinger Band. Because right when it touches the Bollinger Band, usually it's going to what? Come back in, because it only can be out of the Bollinger Band for 5% of the time. Number 5. Well, what do I do if it's in a super trend? You just repeat. You repeat, rinse and repeat. Repeat when it hits the EMA. Don't get in again before it hits the EMA, thinking that it's going to go up. Just wait for it to hit the EMA, be patient, and you'll get more money. If it breaks the SMA, that's a simple moving average below the EMA. Be careful. Be very careful if it hits the SMA. That could be a possible sign of reversal, and you don't want to lose. So that's it for today on reversals. I'm going to go ahead and open it up for questions. This is my YouTube channel, my Instagram, my email if you guys need any help. And then I have also Forex training, education, and tools.